Hey guys, Whitney here. Welcome. I'm just going to give everybody just a couple minutes to file in to the room. And let's see. We've got a couple people. I think it's like, there we go. I was like, it's really slow to connect. What's going on? Okay, good. Woo, technology. Kelli, back to that super fast router. That's not so super fast. We were just
super fast. Everybody has to 100% understand where you live. So it makes perfect sense. We don't like it, but in Boulder, like you said, in between mountains and college town, I can just imagine you fighting it all day.
You can definitely tell when there's a Game of Thrones like show on, because like the whole internet in this area just crashes.
That is so interesting.
So we don't even try to watch House of Dragon on Sunday night. I was like, it's useless.
It is so crazy.
Totally useless.
That's crazy.
All right. Yes, and that it was recorded, guys, for your benefit. All right. Well, I'm going to go ahead and kick us off. Welcome to Passive Investing Made Simple. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. We record this show live on Tuesdays, and if this is your first time here, welcome. The point of the show is that we take a deep dive into various topics related to real estate, so you can put the knowledge into action to confidently go into your first or next deal here at PassiveInvesting.com. So if you're ready to invest, or if you need more information, be sure to check out PassiveInvestingWithWhitney.com for future masterclass sessions. Check our open deals, and if you'd like, you can schedule time with me and we can talk about all things real estate. With that, I wanted to bring back in Kelli Garrett, our managing partner at Rehab Wallet. And Rehab Wallet, that's our debt fund. And so I noticed, and Kelli and I were talking about this before the show, I think I probably confused a lot of people here, because if I actually said, learn how to create a note investment ladder, we would have like quadruple the attendance. But I'm so happy that you guys are like curious and ready to invest time in yourself and learn about, Rehab Wallet, the state of the market with note investing, and then how to build a note investment ladder. Anyways, Kelli, welcome. Tell listeners a little bit about yourself and how you got into real estate, especially on the note investment side.
Yeah, my name is Kelli Garrett, and I am the managing partner of Rehab Wallet with PassiveInvesting.com. PassiveInvesting.com has different divisions in the private equity firm, if you will, but of course, we know it's multifamily and it's self-storage and it's car washes, but we also have a lending arm, and that's where I come into play. And it kind of got started about June of 2020, and we were able to. I have a mortgage background. And I'm great friends with Randazzo, one of the partners at PassiveInvesting.com. He and his wife, and we live in the same city and network in the same groups. And so I went to him one day and said, "Hey, Danny, of course he knew my mortgage experience, but I was private lending my own money at that time." And I said, "Danny, I have more phone calls coming in than I actually have money in my sandbox to lend." And I said, if we could partner up and PassiveInvesting.com can raise the money, I can lend it out. And so that's kind of the way Rehab Wallet was formed. It's kind of like any other business, a startup business. It's just out of a discussion. It was actually out of a walk. Danny and I go for a walk once a week. We kind of just talk. We're weird like that. What's up with his business? What's going on with my business? And then, of course, what's going on with our businesses that we have together. So it's just been a good ride here in June, started June of 2020. And our first 6 months, we did about 11 million. The second full year, we did 51 million. And this year we're on pace to do $100 million in loans. So we have a 100% increase from last year to this year, which is outstanding. But at the same time, we're being super critical and super particular about the loans that we bring in, because we know possibly what's on the edge of the world right now with the market changes, and we'll get into that later. But I've been in the real estate world, if you will, for 22 years. I flipped myself for 18 years. So Rehab Wallet was kind of formed out of the lens of a flipper. And so I built a team out to be able to take that much volume. And yeah, it kind of comes natural to me just because we flip, myself and my partner, we flipped for 18 years. So we kind of, know what to expect and be able to look at deals and see if it's a good deal or not. So that's, that's a little bit about me. I own a mortgage company from 2000, about 2010, a brokerage mortgage shop in 3 different locations. So I have that past history of mortgage experience, and then the flipping experience, which kind of helps me with this Rehab Wallet journey.
That's awesome. So, I mean, your depth of knowledge and experience in this area is just always astounds me. I mean, I know for me, like I built a large portion of my portfolio and wealth doing live-in flipping or BRRRR type flipping, and I know you do lend to those type of investors. And I'm just like, I wish I met you 18 years ago. Where would I be now? But let's switch back to like Rehab Wallet, because we did a previous episode with you like back in January, and I know things have changed, things have shifted in the market. So can you just kind of catch us up with where we are in the marketplace? What are you seeing, where we're heading in the future, and how are you adjusting to respond to those changes? Yeah, I mean,
obviously I told you guys that I was part of the mortgage business back in that time, 2008, 9, and 10. I was kind of expecting this to happen again. If not, I wouldn't be a good leader. So, I do have PTSD back from that time. I don't feel like, of course, it's going to be as bad because back then was a mortgage crash. This could be something different and a little bit lighter, but I mean, we don't know. I'm not an economist. And economists don't even know. We don't know what's on the horizon for us. But I have to say that we're careful about who we're lending to and the asset class that we're going into. So, we don't know what's on like I said, on the forefront of what's going on. But we've added some departments. We've added a complete compliance department to ensure that we are ahead of the game. Actually, we have a compliance director that's ahead of the game, looking at all of our loans, who's going through an extension, who's taking more than 6 months, why, reaching out to them, how can we help you? That's where we are. And I feel like that I wouldn't be doing my job if I didn't anticipate some problems. We are still at 0 default. We're very happy about that. But I think the market I know it has done a small shift. Days on market in every area is different. Now we lend typically in the Sun Belt, the Carolinas, Georgia, and a little bit in Florida. So we watch the days on market in the MLS systems from our local realtors and our partners with them that give us that data. So those have changed a little bit. Again, it's not drastic. It's not anything to knee jerk on, but it is a change. We're seeing it where some of our borrowers now, we have a 6-month term. So back 3 or 4 months ago, I mean, they could borrow from us, rehab in 2 or 3 months, sell it in 5 days, wait for that end buyer to get their traditional mortgage, and they're in and out in 4 months. We've seen them. We're at 155 days right now. Still not bad, but we're watching that. We have to watch that data on a monthly basis again, or I won't be doing my job. But yeah, we've seen it soften a little bit, but it's not anything just yet for us to knee jerk and sit in fear. That's what I want to make sure that I project out there to my team and to our borrowers is that, and there'll be a lot of deals. There'll be a lot of deals to be made during this time if it were to calm down some.
Yeah, I mean, when I started building, my fix and flipping and BRRRR portfolio, I was coming off the 2008, 2009, 2011 kind of softening of the markets, crashes, and picking up property. And so I was working with lenders, and it was amazing that I could get money. I mean, conventional lending you couldn't get at all, but I was able to work with private lenders in order to start, making a profit as the market goes on the upswing. So I think it's still fantastic, and it's still an amazing way for investors to be exposed to real estate. And, we're all the time talking about investments pillars. We have an amazing team that can help preserve capital, create cash flow. Now there's not tax benefits or an equity build to this, but, there's definitely, and I want to get into for what type of investor rehab wallet's appropriate for. But there are a segment of investors that this is entirely a great investment to have in their portfolio for a variety of reasons.
Right.
So let's talk about that. Who is this type of investment appropriate for? And then I want to get into like how some of the nuances and how we can actually build note ladders and create some of that compounding in here.
Yeah, I thought that was a great idea about the ladder system. Our investor is that person. Again, remember, I talked a lot about the mortgage business, but there's two pieces to this pie, really. One is that we raise money in a fund, and I use this money to go invest in the single family fix and flip and short-term mortgages. Okay. So our investor who invests in our fund is one, like you said, that maybe, they understand the fix and flip. They might not want to be doing it every day, but they understand it, watch HGTV, they understand all that, but they just want to be an investor and get a quick return. So that's who our investor is. And then lastly, our investor is somebody that it's a safe, conservative place. We're again, we talked about a piece of pie a while ago, is that we're that little piece of the conservative pie that you might have just sitting in your checking account, waiting to pay taxes at the end of the year. It just sits there. It's a reserve. We can take that money, put it in our fund, and that money is collateralized amongst all 344 loans we have out on the market. That money is not collateralized against one borrower or one piece of real estate. It's collateralized against all mortgages and promissory notes that we have out there. It is a conservative fund. It's just a person that might need their money in 90 days. It's actually a liquidity fund as well. So let's say that some life happens, or like I mentioned, taxes. We see a lot of money coming out right before tax season because their money is in our fund, growing at 6% annually. And now it's time to pay taxes on their apartment complexes, on anything. And so they might leave some money in, take some money out to pay the taxes. But our distributions are monthly, just like a lot of the other asset classes, multifamily, self-storage, car washes. It's a monthly distribution. Just looking for some just interest on your money, conservative, as a conservative play. It's your conservative piece of your pie. It's not aggressive. You're not making, 15, 20, 40% interest on your money. That's not who our investor is. Our investors understand that this is a conservative play, and it's a place that you can get your money in and out. I always call it kind of like a high paying CD, if you will. Our CDs now are paying less than 1% or 1% in the banks. We can use that, collateralize it very conservatively, and pay you 6% annually on your money.
Yeah, Kelli and I were chatting before the show, and I was telling her a story about how this was in my husband's IRA. He liquidated a note, and he was waiting for his next investment. He was following some of the guidance I've given him. I'm trying to take the training wheels off a little bit, and let him drive his own investments in his IRA. And we sat down just a couple months ago to go over our where we were on our quarterly goals that we set. And I was like, how long has that cash been sitting there? And he's like, 6 months. And I'm like, hold on. Do you know how much money you lost out on? Anyways, but that's what I want to get into. So just to recap, this is like a conservative play, capital preservation, because you're secured across, 300 plus loans in a fund and all those promissory notes. So you're not just having that single point of exposure, you're getting monthly cash flow. You can allow it, Kelly, you didn't mention this, that you can actually allow that to sit in there and compound. And we've got a cool like little graph to show you guys here in a little bit, just to see what that actually looks like. If you allowed it to compound over 10 years, you actually get a 10% return, not a 6% return. And I've got the math to prove it. And then I also wanted to, offer up, just a strategy. And if you can kind of help us pick apart, like how can somebody, if they have, dormant cash lying in a checking account that they're waiting to invest, like how can they utilize this type of note liquidation structure in order to keep their money earning in the interim?
Yeah, you had mentioned that about your husband's IRA, the minute, and I know he's probably like, like, oh gosh, well, that was just a nugget that you gave him just then. I mean, he understood it now and it wigged you out, but you understand the feature of compound interest. If it is not out working for us and just sitting idle, it completely messes the entire compound interest effect of our annual percentage rate. So we're expecting, we made 20% rate of return on a note or a whatever on a multifamily deal or anything, but then we just took that gain and sat it in our account for 4 or 5, 6 months. It really just messes up our compound interest. So the beauty of it is 100% to keep it moving. And our fund is a place that it can continue to move in between deals at different times. I see you brought this compounding feature up. I love this. I'll let you explain this, Whitney.
Oh yeah. So I had seen an article that Danny Randazzo had written, and that went out in our newsletter, and Kelly was like, no, that's in our deck. And so I was like, oh, I'm going to bring this up because, Danny laid out the math for us. Like, if you invest in the deal or in the rehab wallet and you say like $100,000 and you let it compound for a year, it's 6.17%. So probably not earth shattering, but as you continue to let it compound there, say like over 10 years, now you're earning a 10.5% return. Why? Compound interest. Like, as what is it? Who is it? Albert Einstein that's credited to say that it's the 8th wonder of the world. Mm-hmm. So anyways, so even for people that are looking at their IRA accounts, saying that I have cash, I would rather be I want to find a note that gives 10%. Well, if that note doesn't give compounding interest, you're still going to be losing out a little bit. You're constantly having to reinvest. Whereas if you go into a fund that has a compounding feature to it, you can allow that kind of like monies to ride, and you are going to boost your effective annual return as a result. Now, what I know some questions are coming in regarding taxes. We'll definitely jump into that here in a minute. But one thing that I really wanted to pull out was the note ladder. Is if if an investor has, say, like $300,000 and they're just waiting to get it all invested, but they have that whole fear of missing out. Like, if I invest it in any sort of vehicle and I find the perfect deal, like in a month or two, I'm going to lose out. I can't go in on the deal. Like if I put it in a note fund. Can you help us understand if that's true or not?
Yeah, you could take a portion of it. You could take a portion of that 300,000, take 25,000, or our minimum investment is 25,000, by the way. But you could take a portion of that 300,000, put it in the fund, pull it out, obviously, when you need it as well. But if you just take increments of that 300,000, you're able to take it out of our fund, put it back into your deal. Obviously, just like with the deal, and then you don't have a deal, you can take it back and put it back in our fund. It's very nimble. That's what these funds are made for, to be able to ensure that our money's not sitting dead, typically.
Yeah, and there's another amazing feature, especially if you've already invested in a passiveinvesting.com deal, you can take your distribution and move it right directly into the fund. So even kind of
That's right.
remove the brain damage there of hitting your
yep. If you have, even if you are in a passiveinvesting.com multifamily deal and you have distributions coming out monthly of $2,000, you can take that $2,000 after you've initially invested 25 with us, take your distributions, and within our company, it will roll into our fund. Now that $2,000 is growing at 6% interest, and it just adds on to this. Once again, because if we just bring it in, if we just take our distributions, and I'm highly invested in multifamily and car washes as well, as long in addition to my own fund here, is that if we just take our distributions out and sitting in an account and wait for that next deal, it completely, I'm not going to say messes up your compound interest, but it definitely doesn't allow it to do its job at the full throttle that it can do for you.
Absolutely. All right, I just want to clean this up a little bit before we wrap up and open up the floor to questions. So with this particular fund feature, there's a couple of different things. One, you can invest in increments of 25K. So, if, I want to encourage investors, if you have cash sitting on the sideline and you have the FOMO of like, what'll happen if I get in an investment and I can't liquidate, think forward about what you want to invest for each quarter. And then that becomes your increment in which you could invest in the fund, and you keep your funds moving and earning interest and compounding. And then you can just liquidate on a quarterly basis. Kelly's like, don't tell people to liquidate on a quarterly basis, but you can, right? Like it's a feature of the fund, right? That's what it's built in for. That way you're taking advantage of this type of, quote unquote, real estate CD as it's built. And then two, if you just have like, funds sitting in an IRA, for solo 401k or something like that, and you really want to be invested in notes, but you're looking at the 6%, if you're not going to touch the money for like an extended amount of time, then compound it. And now you're earning a higher rate of return, annualized return.
Yeah, all right, guys. Use a self-directed IRA. If anybody's got an IRA and have moved it to a self-directed, we could use a self-directed IRA to invest in this fund.
Excellent. Let's see. Is there anything that an investor should consider, before they invest in this type of fund? Who is this not for? I always like asking that question.
I would say it's not for somebody that needs, to be in that piece of a pie that needs to be in growth mode. It's just not going to bring you enough return for you and your family. There's other avenues out there. There's other, again, it could be in between a passiveinvesting.com multifamily deal or car wash deal. However, if you're in growth mode, of course, those are more lucrative. Those are going to give you the biggest bang for the buck, but shouldn't, I've been told, you can't have your entire piece of the pie in one allocation of growth and expansion. We have to keep some piece of our pies conservatively to get more of a blended rate, if you will. So it's for that person that needs to be in growth mode or can be in growth mode. But I still suggest that you kind of pull off a little bit of your pie to go more conservatively. I'm trying to think of that. It's probably the only thing I got as far as who it's not good for.
Yeah, I mean, I guess the other thing that I can think of is if you need your money back in like 15 days or 30 days.
Yeah, that's true.
That might, that might not be an appropriate investment as well.
Yeah, that's true. Yeah.
So Kelly, I'm going to ask, normally we hold an after party, and I do encourage people to ask questions now, but some of these questions that are coming in, I think would be great to answer live. Are you game for that?
Yeah, it's fine.
Excellent. With the compounding option, is tax reported annually or when we withdraw the funds?
It's reported on the K1, so it's annually.
Okay. What type of tax reporting is end of the year? I think we answered that. Is it a 1099 interest or a K1? It's a K1, correct?
K1 to 99 interest. It fits in that interest. So it's going to be interest. And again, just like what Whitney was saying, as far as, there's no kicker on the back end, there's no depreciation. It's strictly interest coming your way.
Yeah. And so for some people that can be like a box 1 income on a K1
Right.
that operates as interest, as opposed to like a lot of our other deals that have cost segregation analyses associated with them, where we're accelerating the depreciation, though, and the income is reported as box 2 income. And generally you get a loss in those scenarios. If you have multiple investments, each 25K, do you get a single account for the total invested, or would it show up as multiple investments?
It shows on your portal as one investment, but it shows inside the portal, it'll show when you allocated the money to the fund, that date. And of course, you'll be able to see it as it drops in. I mean, I do this all the time. I have, if I have any extra money from a business, whether it's business distributions as a managing partner of Rehab Wallet, if I have any extra, I want to allocate it in my conservative piece of my pie, I'll allocate it there. And it might, and obviously you can see on that day, 50 more thousand dropped in there, and you kind of keep it that way. It's within the same LLC that I've chosen to be. I don't change my LLC or I don't go into different businesses in order to do that. Now, let me tell you, in your planning, you might choose to be like, okay, this business account has some money. Like maybe you have 3 businesses for whatever, 3 LLCs, 3 entities. If your entity is different, each time you go in, you will get different K1s, if you will. Okay. But if you go in the same entity, it will be one K1. You see it in your portal, and it'll just see the differences, how it actually is allocated and the day that it's allocated there.
Awesome. Thank you for going in detail on that, because I think that heads off a lot of questions. Are there any penalties or fees if they take out the 25K over, say, X period of time?
No fees, no fees at all.
That's awesome. So, other than, right, like, there's like a 90-day lockout period. That's it. Correct.
Our people, you would sign a private placement memorandum, just like you would if you were going in any of the other asset classes. And we have up to 90 days to get it out. But we work constantly with our accounting department, which and our investor relation team. We have one sole person that works with them on this balancing act to be like, that department will send emails, or we have meetings on our team's call, and it says, we need investor capital out Wednesday of next week of $400,500, whatever the amount is. And so we have to plan that to know how much money we do have for closings this week, next week, and so forth. So it is a balancing act to be able to do that.
Oh my gosh. And you have such a wonderful team that helps with that.
Yes, we do. A wonderful team.
One more question, and then we'll wrap up. Which state is the fund business registered in?
The fund is actually, the LLC is actually a Wyoming LLC. However, the fund, this is an investor relation. I'm gonna spit all over myself for a second. That might be an investor relation question. I don't know that question. I know our LLC is a Wyoming company, but we do that for tax purposes. So, and again, we're guided by a very good attorney. So I'm just going to suggest that you do the same. We can invest in any state of the union, not invest, but we can lend to any state. We've chosen to start out on the lending side in the areas that we know well. I know the Carolinas extremely well. I'm from this area. Now I live in this state of South Carolina. We understand the migration and the job growth of the areas that we're in. So there's no sense for us to go to Idaho and go gather business from an area we know nothing about. Right now, we're competitive and we can do a lot of damage in the Sun Belt area that we know and understand. Again, we want to invest. We want these borrowers to be able to turn around and sell their house, get this fix and flip money, and come back to us. But we want them to sell it fast, and we want it to be in areas where there's a lot of job growth and migration. I kind of went around that subject because I really don't know the answer.
Well, no, but I think that you brought out some additional details is that you're very familiar with the areas that you're in, you know, from personal experience and also from your network. And, you know, there's enough business there. Why go outside of that? However, the business has been structured as such that we can expand into other markets,
right?
You know, and keep up with building out the fund. So investors, you know, we can continue to grow the fund in general. So, you know, really, you know, it's kind of like a niche down strategy, and that's what you want. Like, you know, we don't invest in multifamilies across the entire US for a very specific reason, because we have our systems and teams, you know, focused on a very specific area. All right, guys. We have just a couple more questions, but I wanted to direct you guys to the link in the chat box. So if you're here live, I dropped in the offering memorandum information for Rehab Wallet that has, you know, a ton of different FAQs. I wasn't intending on doing that, so this is not a solicitation for investment or anything like that. But I know several of you have asked for that information. I did go ahead and drop that into the chat. If you're listening to this after the fact, feel free to reach out to me at whitney@passiveinvesting.com, and I'd be happy to send you that information. And just a couple other questions came in about fund specifics, people that came in late. This is a debt fund. It does have monthly distributions. And then how quickly are investors invested? When can they expect to get distributions kicking out from the fund once they invest?
Yeah, the investors, if you invested tomorrow, it's typically about a week to 2 weeks before the money's actually allocated in our, actually, let me use this word, put on the street, if you will, in a deal. And that's just because we have closings going on every single day, every single week. So if Whitney, if you brought in money 2 weeks ago, yours would be in the queue first. And yours would go out, and then we would work our way up to be able to pull how much money we need in order to close what we need to close this week. So it is typically the complete opposite. We have more deals coming in than we've been able to raise. Now, let me explain that. The raise, we have done we'll do $100 million this year, which is 100% increase. We don't want to be too fast. We don't want our growth to manage us. We want to manage our growth. So I'm saying no to some deals because of our fund need some funds, if you will. But at the same time, we're managing that. We're not aggressively, you know, soliciting deals at all. But at the same time, and the investor relation team has been wonderful this year. We've just really paced. Had a strong pace this year in originations.
Excellent. Well, Kelli, as always, so great to connect with you and
absolutely same here, Whitney.
Yeah, you know, learn more about the debt fund, the various ways that investors can utilize this, you know, to grow their investments or to, you know, maximize profits as they're in between investments. If somebody wants to get started, how can they find you?
If you have a deal, you know, if you're looking for us to fund a deal, then you would go to rehabwallet.com/borrow and input that deal there. If you're wanting to find me personally, my email is Kelli, Kelli @rehabwallet.com. And if you're interested in the debt fund, of course, we're going to, you know, call Whitney or email Whitney. But at the same time, if it comes to me for a debt fund question or you're ready to start, then of course, I will probably forward you on to our investor relation team, because my job is to ensure that the lending piece of it gets done and get done properly with very few defaults, if zero defaults.
Excellent. And that track record is so important in this space. And I'm glad that we have such an expert here, keeping the eye on the ball and helping us manage through this, very interesting environment.
Absolutely.
I'm also going to pick out, again, this is not a solicitation for investment guides. If you're here live, you get this little added bonus. I did drop in the offerings page on our passiveinvesting.com website. It seems like a lot of you guys are actually very much interested in getting additional information and potentially committing to the deal. Again, not a solicitation for investment. Feel free to check out that offerings page. As always, Kelli, thanks so much for joining us. And if you are here live, thank you for spending your most valuable resource, which is your time. And we are about to start our after party.
All right.